Hello, this is Steve Sanangelo of the SRS Rocket Report, and in this video update, I'm going to discuss silver investing during the coming financial storm. Now, we're not quite there yet. We are in a financial crisis, and I believe it's going to be much worse than what took place in 2008 and 2009. And unfortunately, the analysts on CNBC and Bloomberg, I don't think they understand the carnage and the destruction that is taking place that's hidden in the supply chain, in the financial system, whether it's the pension plans now, the 401ks, the money market accounts, the bond market, the credit markets. And as a lot of large cities in the US and around the world and countries are on lockdown, and they're going to continue to be on lockdown, I believe the US now, according to Trump, is on lockdown to the end of April. That's another month. This is really going to damage the system. And so we're going to get into a financial storm in the next several months. So I believe the precious metals, you're going to see a lot more investors move into the precious metals, and there just won't be the supply. All right, let's get started. Now, this is a chart as of last week on Friday. I've got an update showing in a minute, but I wanted to start here. This is for the larger online precious metal dealers. You probably know who they are. I've blacked them out because I'm not quite sure if these prices are exact, but it just gives us an idea. So this is for Silver Eagles as of March 27th. One dealer here. If you purchased from them last Friday, it was $26.99, and if you wanted to sell back to them, it was $16.56. That's more than a $10 spread. These other companies, it was much lower spread, a much smaller spread, about $5. This one was an estimate. It could be higher. They don't publish their buyback price, so it was an estimate. But again, these three dealers are selling about the same price, and you could sell more. You can get more by selling back to them. Now, if we look at what's happened today, this is as of March 31st, Tuesday. We could see that this dealer, it's about the same. It's a little bit less, but there's still a $10 spread between what you buy from them and what you could sell to them. Now, the thing is, they don't have any availability until June 25th. That's what it says on their website. So that's more than two. We've got all of April, all of May, and most of June. That's almost 3 months to get any product, to get the Silver Eagle. This one here, they're out of stock. So again, this is an estimate based upon what they had last week. These two dealers did say they had stock. That's what it said on their website. I'm not sure. I don't know if there's still going to be a delay in getting it, but we could see that their price is about the same. And you're going to get more compared to these other companies if you sell to them now. But again, we could see that two of these companies, you won't get any Silver Eagles. One's out of stock, and then one is for 3 months. Now, that's all changed now because this is an article by James Anderson at Silver Doctors. As of yesterday, the U.S. Mint West Point facility is shut down for 2 weeks, and that's due to, I believe, a security officer working there was tested positive for the coronavirus. So now they're shutting down the facility, which means the U.S. Mint will not be selling any more silver or gold eagles to the authorized dealers. So that product is now off limits. Now, there's an interesting update with the silver price. We've had the big sell-off here, and during the last COT report, it ends on Tuesday, every Tuesday. The price was $12.49 on March 17th. And over the next week, on Tuesday, on the 24th, it went up to $14.26. So the silver price increased $1.77 since the last COT report, but there were an additional 10,000 short contracts were liquidated as the price went up. This is quite interesting. And we could see, again, the short contracts, the longer the bar is the higher the number of short commercial contracts. So we're seeing that liquidated about 10,000 in this actually almost a $2 price move. Now, on the other hand, if we look at gold during the same COT reporting period, gold increased $135 since the last COT report, but they added 10,000 short contracts since this last period. And as you could see, it's increased. And gold is still closer to it's the high of the amount of short contracts. Whereas if we go back to silver, we can see silver is moving back to a low, which means the price, the paper price, the futures paper price, and we'll get into that in a minute, it's getting down to a bottom. Gold, it's still, even though there's shortages getting gold bars, I know that, but I just wanted to show you, silver seems to be setting up better right now than gold if we just look at the COT report. Now, Scott Minerd, I talked about him a few weeks ago in one of my video updates. He was at the Davos, Switzerland meeting, and he said that silver was his bet for the year. Now, things have changed since the global contagion, but he was on CNBC yesterday, and this is what he said. As the data continues to worsen, it would suggest that we're going to get to a place worse than the financial crisis of 2008 and 2009. And I agree with him. And he made some comparisons of what happened in the markets in 2008 and 9 and what's happened so far currently. And I believe we have much more damage in the financial system as well as the stock markets. So this chart is comparing the crashes in the markets. And we could see we've got the 2000.com crash. We've got the Great Depression in the dark blue. And then right here in the orange is the 2007 financial crisis. And from peak to here, we could see it was down about 55%. And then the 1987 Black Monday, where it fell 25%, is right here. Now this blue, right here, 2020, the coronavirus. This is where this little light blue chart line right here, we're about 75% down. The Dow Jones is about 25% down since its peak in February. Now this is a long-term Dow Jones chart, and I'll show you why I believe the markets aren't bottoming. We've got a long way to go. I believe we're going to see the Dow Jones below 10,000 points within the next month or so. Now, in 2008, or let's say in 2007, the Dow Jones hit 14,000. And then over the next year and a half, it sold down 55% to about 6,600. So when the US unemployment rate reached 10%, the Dow Jones lost 55%. Here is a chart of the unemployment rate. Yes, I know it's manipulated, but it's the best we can go by. And back in 2009, when the markets were at a bottom, they had sold off, the unemployment rate reached 10%. You can see the number right here. The stock market had sold off 55%. Now, the stock market, the Dow Jones index got up to 29,500. It's about 22,000. I think it sold off today about 400 points. Let's say about 22,000. It's 25% off of its high. Well, it says the Dow Jones is only down 25%, but unemployment is forecasted in the United States to reach 15%. It's at 3.5%, or let's say as of the end of 2019. Now, with all the lockdowns, all the shutdowns of all the restaurants, all the retail, the airlines industry, the vacation industry, the sporting, all the sporting events have been shut down. They're estimating it's going to be 15% unemployment. I think it's going to be even worse than that. So if the Dow Jones fell 55% on 10% unemployment, what's it going to fall on 15% unemployment? I mean, if you go all the way back to 81, the unemployment rate at the worst was 10.5%. To go to 15, that's way up here. I mean, that's where it would be. So I believe we're going to see 60 to 75% decline in the Dow Jones index. And that's going to be good because we have to remember at the end of 2008, the price of silver and gold bottomed. And they started to increase over the next several months. The Dow Jones index did not hit its low until March 2009. We're going to see the same thing moving forward. Now, that's the stock market. Now, many of you have seen this chart. This is the Federal Reserve's balance sheet. And during the 2008-9 financial crisis, when the money market accounts were freezing, when gold went up $100 in one day, they, they had to come in and they backstop the market. And so we saw in just here, the Federal Reserve balance sheet increased 1.1 trillion in less than 1 month, 2020, right here. It increased 1.1 trillion. They used for liquidity to backstop this global contagion. Now compare that to the 1.3 trillion in 2009 during 2 months. We're just seeing the beginning of what the Fed is going to put on its balance sheet. It's right now, as of March 25th, 5.2 trillion. We're going to easily hit 6 trillion in the next month. And so this is just another indicator showing that the financial system is continuing to weaken. Now, I want to discuss, I get a lot of questions still about the paper price, the manipulation of the paper price, and why is the paper price so low, the futures price so low, and the physical price for investment metal is so much higher. It's $10 higher. Now, there's a reason for that I discussed in my last video, which I'm going to explain a little bit more. We have to remember, this is based upon 2019. Physical investment demand last year was 178 million ounces. Industrial demand, jewelry demand, and silverware demand were 824 million ounces. So the wholesale 1,000 ounce silver bar demand from industry, jewelry, and silverware is likely down or will be down 40 to 50%. Nobody's going out and buying silverware. They're not. And then the jewelry demand for silver jewelry, the retail stores, the malls, they're shut down. It's just for essentials. People are not buying silver jewelry. And a lot of the industry is shut down that uses silver. So I'd say the silver market that consumes silver, besides investing in physical silver, is probably going to be down 200 to 300 million ounces. So this is the reason why we're seeing, part of the reason we're seeing the paper futures price. A lot of the industry does not need the silver. They don't need the silver. Just like a lot of the oil industry, the demand for oil has collapsed. That's why the price of oil has collapsed, because there's half the demand for oil right now, or even less than that. So this is the 1,000 ounce silver bar. While physical silver retail investment demand has surged and it continues, the game changer will be the 1,000 ounce silver bars. And I'll discuss that in a minute. Now, the reason why we're seeing a lot of people is, well, most of the people getting into the precious metals have already been in precious metals, but there are new investors. I've listened to a few precious metal dealers, and they're getting a lot of new buyers for the first time. And these are likely people who we know, friends and family, that we've been telling to purchase precious metals. And now with this crisis, they're finally pulling the trigger and purchasing some. Now this is they call it the Exeter pyramid, and it shows the biggest value, which on the top, which actually is the weaker financial asset is on the top. And as you go down to gold, it's the higher quality store value. So we've got the quadrillion in derivatives. We've got the private business in real estate at 300 trillion. I'm not quite sure how old this chart is, but I'm giving you an idea. And then you've got the corporate municipal bonds, securitized debt, and the stock market. And then you've got the government bonds, you've got bank money, and you got base money, and then you've got gold and silver. I can include silver in that. So as this global contagion continues to spread, there's more fear, and you start getting a breakdown in the upper, and people start moving down. I believe we're going to see serious trouble with the bond market in the next month or so. And that's going to cause trouble with actual bank accounts, the money market accounts, all the money that's the digits that are held in the commercial banks, and then as well as the fiat money, the currency in circulation. So right now, the total gold value, and this is identifiable above ground investment stocks, central bank and private, is valued about 4 trillion. Compare that to a base money supply, which is about 28 trillion. That's 7 times more than all the gold. Now get silver, total silver value is only 40 billion. It's 100 of the gold. Again, to me, I believe the most undervalued asset is physical silver, and we'll start to see that in the future as more and more investors move into silver to protect wealth. Now, if you've been following my work, you cannot have global GDP growth or expanding economy, global economy, without expanding oil production. They just go hand in hand. There's no other way you can do it. Now, this is a big problem. This was a chart that came out last week. I put it in one of my articles. And the IEA, the International Energy Agency, said that we would see about a 19 million barrel day decline in demand for oil. And here we've got, they got the jet fuel total by April. And I just rounded it to 20 million barrels down. But if we look at an update, which came out yesterday, Goldman, the oil industry, Goldman Sachs analyst, the oil industry will never be the same after the coronavirus. I totally agree. And I think a lot of people don't understand. They're looking at this global contagion and as a linear change. It's a non-linear change. Things are going to really start to fall apart and they won't come back. Now, according to the investment bank, Goldman Sachs, the Saudi-Russian oil price war, which we hear about in the media, has been rendered irrelevant in the face of the enormous demand destruction as major economies remain on lockdown and demand for gasoline and jet fuel continues to tumble. Even diesel for semi-tractor trailers, transportation, that's also falling, not as much as gasoline and jet fuel. This is the first analyst I've heard that has said that, because you hear the continuation of the US politicians, the oil industry saying that the Saudis should cut. It doesn't matter. If they cut 1 to 2 million barrels, we need to cut 20 million barrels. But here's the clincher. This week, Goldman sees the world oil consumption down 26 million barrels per day. Right here, 26. That's 6 million more than the 20. This is much worse. It's 25%. It's actually more than 20. It's 26% of the typical global demand, which in 2019, the world was consuming 100 million barrels a day. 26 million barrels down. I don't believe we're going to recover from this. And let me show you that chart again. Again, they said it was about 19 million barrels a day last week. Goldman Sachs says it's 26. This is the V-shaped recovery. This is the demand for oil would fall, and then it would recover in May. And in June, we'll only be down 6 million barrels a day. And by the end of the year, in December, the world will only be down 1 million barrels. This is totally unrealistic. We're not going to have this V-shaped recovery either in oil consumption or in the stock market. It's probably going to look like an L-shaped recovery. And so if it's down to 26 million barrels, I doubt that we're going to get back to minus 10. I don't see it. I think there's just going to be too much damage. So that brings me to this chart I showed you last week. Due to the collapse in the supply chain and what's the destruction taking place in the financial industry, silver mine supply, especially as a byproduct of base metal mining, will start to decline considerably in Q2 and Q3. I think it's going to even happen. It's even happening now. We're just not seeing the evidence yet. And that's mostly copper, lead, and zinc. If I forecast that silver industry demand and silverware demand and jewelry demand is down 40 to 50%, you can also assume that copper, zinc, and lead, that demand is down considerably as well. So we could see silver mine supply could easily fall 100 and 150 plus million ounces by the end of the year. So supply is going to fall from silver, but physical retail investment will continue to surge higher, pushing premiums up even higher. However, as the financial system becomes under more strain, we head into the financial storm. Large investors, hedge funds, and institutions will start buying the 1,000-ounce bars. I believe that's going to happen. And as I said here, again, while physical retail investment has surged, there really isn't a lot of investors, the institutions, the hedge funds, or the large investors buying up 1,000-ounce silver bars. There's still a lot of people. Most of it is in the smaller products, the Silver Eagles, the rounds, the 1 ounce bars, 10 ounce bars, 100 ounce bars, and that there's a backlog to get that. But I do believe when we start seeing some serious cracks in the financial system, the market, the stock markets continue to sell off, the light bulb is going to go off. I believe the Scott Miners, the financial guys, are going to start moving into the 1,000 ounce bars and using these not for consumption in either industrial, jewelry, or silverware. They're going to hold them as an investment. I do believe we're going to see that happen this year. Now, in my next video, I want to discuss, I'm just going to show you this because I think one of the most important things that investors, whether the precious metals or regular investors, they don't understand the energy of the complexity. This is from the technical report on the pre-feasibility study for the North Territory, Australia for Vista Group. It's their Mount Todd Gold Project. This is basically a simplified process flow diagram of processing gold. I want you to understand, not only is this complex, every piece of machine that you see here, the sump and the pumps, the cyclones, this mill, the trash screen, this pre-leach thickener funnel, the ball mill, all these things, the regeneration kiln, the acid washing, and then we have the leach tanks. All of this has to be, all the materials have to be mined, extracted, have to be made into products, and then shipped to the site. It is so complex, it's all based on the energy. Now, if the supply chain starts to break down, then this complex system becomes problematic. I'm not saying it's going to happen this year, but as time goes on, so we're going to see less supply coming from the metals in the future, from gold, silver, and the base metals. And in that next video, I'm going to show a time lapse. This is Goldcorp's Penasquito Pyrite Leach Project. I did an article last year about the massive tailings dam that Goldcorp had built just to store all its waste tailings. It's massive. But this is an addition to process gold. Look at all the different parts here, all the equipment that had to be manufactured, transported, and then put together. Basically, an ounce of gold and an ounce of silver, the value of it is its equivalent energy. It's based upon its energy equivalent value. Even though there's all this equipment here, this equipment was made and was manufactured and delivered here, basically on all the energy in all stages, in all forms. So you need to understand why the precious metals are so valuable, because the energy is now becoming problematic, and it's really going to destroy the financial assets. So I wanted to thank you. I do believe silver investing, we're just beginning to see that this is the beginning stages of it. As the financial system becomes under more strain due to the energy, it's all about the energy now too, you're going to see more investors move into physical precious metals to protect wealth. Well, thank you once again for watching this last video update at the SRS Rock Report website. If you would please consider supporting this work at the srsrockreport.com website with PayPal or Patreon, I'd appreciate it. And if you have not yet subscribed to the SRS Rock Report YouTube channel, please consider doing so. Thank you.